Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Friday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So today I wanted to talk about the long-term outlook on mortgage rates, specifically from now until the end of 2025, and why I think there's a very real possibility that interest rates could actually go higher, or at the bare minimum stay around the same, while the Fed funding rate goes down. Just to kind of review where we are right now, October 18th, we're at a point where the Fed has cut rates 50 basis points, and in all likelihood, they're going to cut another 25 basis points next month in November. And yet mortgage rates have pretty much steadily increased since that rate cut. So why is that? I think I've explained this before on the channel, but I want to try and make an analogy that might make it easier to understand. So the common misconception is that the Fed funding rate is directly tied to mortgage rates. So if the Fed cuts 50 basis points, mortgage rates are going to come down 50 basis points. Some people assume, well, not right away, but over a couple weeks, it'll be 50 basis points. And that's not the case. The analogy I'll make is to stocks, and specifically a lot of the newer like tech stocks where the current stock price is based on future profits. So let's say you have this company that is banking on really crazy high profits in the future. They might have one quarter where they have really good profits. And if you're just looking at that, similar to looking at, oh, the Fed cut rates, that's good. Oh, you had a lot of profit, that's good. But compared to those expectations, they're not as good. That might hurt the stock price, or in this case, cause mortgage rates to go up. To explain what happened in September in this analogy, I would say this is as if, say you have this stock that came in better than expected for the quarterly expectations. Maybe they're expected to show 200 million in profits and they show 250. You think, oh, great, the stock's going to get better. But at the same time as that is happening, the projections for future profits goes down a lot. In this case, with the Fed box plot, with their expectations for future rate cuts coming in a lot lower than the market, and the stock price goes down as a result. So with this in mind, let's look ahead to what the market currently is expecting. As of today, the market has priced in a 91% probability of a rate cut of a quarter point in November. So getting a quarter rate cut is not going to help or hurt mortgage rates in and of itself. What is currently moving the needle is the probability of a rate cut in December, January, and March. Right now, with more data showing that inflation is still hanging around and that jobs are still strong. There's an initial uptick in jobless claims, but that's starting to come back down. So now the market is pretty sure there's going to be a rate cut in November, but not as sure if there's going to be continuous rate cuts in January and March and so on, which the market had been expecting pretty continuous quarter point rate cuts from here on out. Looking even further ahead, really September is where you want to look. Per the CME Group, which is kind of the gold standard for Fed rate projections, they only go out 14 months in advance. So you can see from September through December, basically the rate probabilities stay the same, which means that currently the market is expecting the Fed to cut rates until they get to 325 to 350, so 3.25 to 3.5%, which is a 150 basis point or 1.5% cut from where we are now. And it's expecting that will hold rates at that point, which is called the neutral rate. That's where the Fed is keeping rates flat at a point where we're not in a inflationary or recessionary point, where we're good economically, and this is just kind of the rate that they want to naturally stay at. So that rate, first of all, Historically, it is very rare that you stay for a long time in anything close to a neutral state because things happen. You get recessions, you get inflation, printing money, whatever. You get big events, wars that take you out of that neutral state, and the Fed is, forced to either cut or raise rates depending on what happens. However, what that eventual number is very important, because right now, at least, we are in a pretty good path to getting to that soft landing where you still have good jobs and inflation is low. Historically, the past 60 years, there haven't been a lot of long periods where you can say we're at a neutral rate. The longest I can see is in the early 90s, from like 92 to 94, the Fed kept rates within 0.5% for 2 years. And that rate was 3%. So similar to where the market is projecting the neutral rate to be right now. But ultimately, how far above or below that neutral rate that we get, that's what's going to determine whether mortgage rates go up or down. It's not the fact that the Fed is going to continue cutting rates, which they will to some extent. It's where are we relative to those expectations. If the Fed decides, hey, the neutral rate, I think it's better if it's 4 to 4.25%, that's not going to be good for mortgage rates. On the other hand, if they decide, let's cut it all the way down to 2%, that will be good for mortgage rates. As always, as more news comes out that influences what the market thinks and moves mortgage rates, I'll put out more videos to explain it, but I wanted to kind of shoot this, taking a step back to explain more of the long-term view, which is, let's be clear, it's tougher to project. That's why I don't do it a whole lot. Talking about the rate projections from the CME group, this probability of the neutral rate, the 3.25 to 3.5 that I'm talking about, there's only like a 30% probability of that. It's way spread out above and below that because they really don't know. And ultimately, the Fed, when they chose to hike rates, I don't think they had a number in mind. We want to get to 5.25 to 5.5 no matter what. They're just making decisions based on the current data. And if more data comes in to refute their hypothesis, they'll change course. It is all going to be based on the data. But again, it is noteworthy to look ahead to try and get a grip on what's going to influence what will happen. As always, if you have any questions or comments, shoot them below, or feel free to call, text, or email me. But thanks for tuning into this one, and I will see you next time.